What if a central bank keeps interest rates frozen while the economy slows, inflation eases, and the currency slides toward a 16-month low? That is exactly what is happening with the Thai Baht today, Saturday the 22nd of August 2026. DBS economists Taimur, Baig and Radhika expect the Bank of Thailand to keep its policy rate unchanged at 1% at its August meeting. The baht is trading near 32.67 per US dollar, having recovered from around 33.8 in late July, its weakest level since April 2025. The key question is not whether the Bank of Thailand holds, but what that extended pause tells us about the real health of the Thai economy. Recent data explains why the Bank of Thailand feels no urgency to move. Thailand's real GDP growth slowed to 1.9% year-on-year in the second quarter of 2026, down from 2.8% in the first quarter. That brought first-half growth to 2.4%. The slowdown was driven by weaker private and government consumption, even as investment expanded strongly. DBS economist Chua Han Tang revised the full-year 2026 GDP forecast upwards to 2.1% from 1.6%, because the drag from the Middle East conflict turned out less severe than originally feared. That mixed picture matters. Parts of the economy are soft, but others are holding up, and the central bank does not want to overreact to a single weak quarter. On the surface, Thailand's inflation numbers look reassuring. Headline inflation eased for 3 consecutive months, reaching 1.9% year-on-year in July. That sits comfortably inside the Bank of Thailand's target range of 1 to 3%. DBS also cut its 2026 inflation forecast to 1.7% from 2.5%. But the cause matters more than the number. The moderation came largely from lower energy prices, not from weak demand. That allows the Bank of Thailand to treat inflationary pressures as temporary and supply-driven, which removes the case for higher rates. In plain terms, cheaper fuel is doing the central bank's job for it, so the Bank of Thailand can stay patient and keep policy accommodative without looking reckless. So why did the Thai baht weaken in late July, and why does the current account matter? Since March 2026, Thailand's current account has been in deficit because imports have surged, pushed higher by energy prices and strong investment spending. A current account deficit means Thailand is spending more foreign currency than it earns, which naturally puts pressure on the baht. That is why the currency slid to around 33.8 per US dollar in late July, the lowest level since April 2025. It has since strengthened to around 32.67 by the 22nd of August. The partial recovery suggests currency traders are now focusing on the Bank of Thailand's steady hand and the tourism rebound that began in July, rather than just the import bill. For ordinary households and businesses, this policy pause keeps borrowing costs low at a time when confidence is fragile. With the policy rate at 1%, mortgages, consumer loans, and small business credit remain affordable. Private consumption has been weak but stabilizing, and government stimulus introduced from June 2026 is expected to offer extra support. The recovery, however, is uneven. Foreign tourism was soft over the first half, yet visitor arrivals rebounded in July. Goods exports and private investment remain strong. So an exporter might be enjoying solid orders, while a domestic retailer is still waiting for consumer confidence to return. The Bank of Thailand is effectively choosing to let fiscal policy do the heavy lifting for growth, while keeping monetary conditions easy. DBS's core argument is that the Bank of Thailand has little urgency to adjust policy in the near term. The central bank wants to support growth that is low and uneven, while expecting inflation to ease alongside energy prices. There is also a global uncertainty factor. Geopolitical risks remain, even if the Middle East impact on Thailand has been less severe than initially feared. After June's unanimous decision to hold, the message was clear. The Bank of Thailand believes its accommodative stance is appropriate. A rate cut could fuel further baht weakness and import inflation, while a hike would hurt a fragile domestic recovery. Holding at 1% is therefore not indecision. It is a deliberate balancing act between two very different risks. One of the most important stories behind the baht is Thailand's two-speed economy. The strong side is goods exports and private investment, which have remained resilient. The weak side is private consumption and foreign tourism, although both are stabilizing. July brought a rebound in visitor arrivals, which helps because tourism spending is one of the fastest ways to narrow the current account deficit. At the same time, government stimulus from June 2026 is designed to support domestic demand. This backdrop matters for the baht because an improvement in tourism and household spending would reduce the need for central bank action, while a relapse would increase pressure for a rate cut or a weaker currency. Looking ahead, for triggers could move the Thai baht and the Bank of Thailand's stance. First, watch the August baht meeting language for any change on growth or inflation risks. Second, oil prices remain the wild card. Another energy spike would widen the current account deficit and weaken the baht, while falling prices would support the currency and keep inflation low. Third, the tourism recovery needs to accelerate, because visitor spending is one of the fastest ways to improve the current account. Fourth, US dollar moves matter. If the Federal Reserve changes its own policy outlook, the Thai baht will react through the dollar pair. Based on current evidence, the most likely near-term path is a range-bound baht with a cautious and patient central bank. The takeaway for anyone watching the Thai baht today is this: the Bank of Thailand is likely to keep its policy rate at 1% for the rest of 2026, not because the economy is booming, but because conditions do not justify a move in either direction. Growth is slowing but not collapsing, inflation is inside target, and the baht's July weakness has eased. DBS expects the hold to continue, and for now the data supports that view. The real story is an economy running at two speeds: strong exports and investment against soft consumption and tourism. That gap, more than any single rate decision, will decide where the Thai baht goes next. Subscribe for more currency and central bank analysis as these forecasts unfold.